You know, with the recent passing of Charlie Munger at 99, the world really lost half of one of the greatest investing partnerships we've ever seen. For decades, he and Warren Buffett at Berkshire Hathaway, they didn't just pick stocks. They gave us all a masterclass in how to think rationally. So today, we're going to dive into 12 absolutely essential lessons on money, markets, and life from these two legends. And that quote right there, that just perfectly captures who Charlie Munger was. It also gets to the very foundation of their success. See, it was never about some secret formula or a complicated algorithm. It was about a relentless, lifelong hunger for learning. And that idea, that theme, underpins everything we're about to talk about. And that really brings us to a crucial point. It's so important to understand that these aren't just tips for your stock portfolio, not at all. Together, they form a complete philosophy, a kind of mental toolkit you can use to make better decisions in, well, pretty much every part of your life. It all starts not with what you think, but how you think. So let's start with part 1, mastering your investor mindset. Because what Buffett and Munger taught us over and over again is that before you can even dream of conquering the market, you first have to conquer the irrational, emotional impulses inside your own head. Their entire foundation is built on this one habit: always be learning. I mean, these guys were famous for spending most of their days just reading. Munger, especially, he was always stressing that to really understand business, you needed a broad latticework of mental models from psychology, physics, biology, history, the whole shebang. For them, this wasn't just a hobby. It was their #1 competitive advantage. Okay, now this slide is huge because it gets to one of their most radical ideas. You have to completely redefine risk. See, the academic world, they'll tell you risk is volatility, how much a stock price bounces around. But Buffett and Munger thought that was just absurd. To them, a stock price going down doesn't make a business riskier. It makes it a better opportunity. The only risk that truly matters is the risk of permanently losing your money. That shift in perspective changes the entire game. And that leads to this idea of extreme patience, which Buffett explained with a classic baseball analogy. So let me just ask you, in a baseball game, what happens if you watch 3 perfect pitches go right over the plate and you don't even swing? Yep, you're out. But here's the kicker. In the stock market, there are no called strikes. You can stand there at the plate and watch thousands of pitches, all these different investment opportunities, fly right by. You don't have to swing at anything. You can just wait and wait and wait for that one perfect pitch right in your sweet spot. That's not being indecisive. That's what they call discipline. This brings us to a really key evolution in their thinking, and it was mostly thanks to Munger. See, early on, Buffett was a pure cigar butt investor. He was looking for dirt-cheap companies that maybe had one last puff of profit left in them. But Munger convinced him that you don't have to choose between value and growth. A truly great company's ability to grow in the future is a massive part of its value today. They're really just two sides of the very same coin. Okay, so once you've got that internal mindset dialed in, let's move on to part 2 and see how they actually used these ideas to navigate the messy, chaotic, and often irrational world of the stock market. You gotta love this quote from Buffett. It gets right to the heart of their skepticism of Wall Street's so-called innovations. They basically viewed complex financial products as a poker game where the house has all the odds stacked in its favor. Their rule was simple. If you can't understand it, it's probably designed that way for a reason, and that reason isn't to benefit you. So what should they look for instead? Simple. They looked for companies with wide economic moats. A moat is just a durable competitive advantage, a super strong brand, a low-cost structure, something that protects the business from competitors, just like a real moat protects a castle. A company with a strong moat has pricing power, which is an incredible defense against things like inflation. This leads to a big reality check. They believe that markets, for the most part, are pretty efficient. But, and this is a big but, they knew markets are made up of flawed, emotional human beings. And sometimes those humans get swept up in speculative manias, and the whole thing just goes haywire. Your job as an investor is to stay rational when everyone else is losing their minds. Okay, so given that markets are tough to beat and can sometimes go completely nuts, what is the advice from the world's greatest active stock picker for the average person? Here it is, and it might surprise you. Just buy a low-cost index fund. Buffett has said this time and time again. He thinks it's the single best choice for the vast majority of investors. That's a true masterclass in knowing the difference between what works for a pro and what works for the rest of us. All right, for our final part 3, we're going to see how all these investing principles aren't really about money at all. They're just expressions of a much deeper philosophy for living a richer, more meaningful life. Take this idea of living with absolute integrity. Buffett offered this beautifully simple newspaper test. Before you do something, just pause. Imagine it being written about in detail on the front page of your local paper, read by your family, your friends, your neighbors, everyone you care about. If you'd still feel okay about it, then go ahead. It's such a powerful, practical guide for how to behave. And that sense of integrity flows right into a huge dose of humility with this idea of the birth lottery. Buffett often talks about how he won the birth lottery, recognizing that his specific talents just happened to be super valuable in the society he was born into. It's a really important reminder that our success is never just about skill alone. Luck plays a massive role. So after all this wisdom on markets, on human behavior, on integrity, what is their ultimate advice? What is the final lesson? The real secret to a happy life, according to Warren Buffett and Charlie Munger. It's just 2 words: low expectations. It's so simple, so counterintuitive, and so brilliant. They believe that the main source of human misery is the gap between what we expect to happen and what actually happens. Their solution? Just systematically, consciously manage your expectations downward. And they applied this principle to literally everything. Munger used to joke it was the key to a happy marriage. Buffett applied it directly to his portfolio, making a habit of mentally subtracting 30% from his current value just to prepare himself for the fact that unexpected bad things are inevitable. It's this incredible mental buffer against disappointment. So whether it's investing or relationships, maybe the path to contentment isn't about achieving more, but about expecting less. And that leaves us with one final thought, a question for you to take with you. What's one expectation you could consciously lower right now to improve your own life?